Hello everyone, welcome to another session on dollar INR. Today we want to talk about how the exchange rate has become so stable for the past 2 weeks and how the volatility environment has changed and how that will affect your risk management hedging decisions. Okay. First, I want to zoom into this particular area and I want to show you what has happened. If you look at these 2 weeks, the place here, the prices have become very narrow. Okay, the prices have become very narrow. There is hardly any volatility. If you see here, there is hardly any volatility. Now let's come back to the full screen and let me tell you what has that resulted into. Okay, if you look at this red, blue and green, this is what we call as the Bollinger Band. Okay, it is the standard 22 standard deviation Bollinger Band. And if you see, the Bollinger Bands here have slightly started narrowing. Let me just clean this up. Okay, so see, this has started going higher and this has started coming lower. That is getting reflected in this indicator in the middle, what we call as the bandwidth indicator. Okay, now if you see that bandwidth indicator, that has come very low. Okay, remember this is the squeeze line. The bandwidth squeeze line means that the bands have narrowed to the lowest level in the last 125 days. So that lowest level is this line and we are coming back to that level. Okay, so Bollinger Bands is squeezing. What does that indicate? That indicates the volatility in the exchange rate has come down substantially. Another very good indicator which tells about that volatility factor, if you look at this, this is what we call as the average true range. Okay. Now average true range is another very good volatility indicator and that also tells us about volatility. Standard deviation is what is used in Bollinger Bands, but average true range looks at amplitude of prices, the high low level of prices in days and in weeks. So if you look at this average true range, how it has gone higher during volatile times and how it has collapsed in the last 1 week or so, and it has reached the lowest levels. Remember, look at these levels here. Okay, these are the real low levels of ATR and now it is inching to that range. So the lowest levels of ATR since October, November, December last year. Okay. Now what am I trying to tell here? Okay, what I am trying to tell is that the volatility in the exchange rate has significantly got down. We haven't reached a Bollinger Band squeeze yet, but we are reaching there. Okay, so in low volatility environment, what should we do? Let me show you another table, another chart, and then I'll come back to the real answer. If you look at this chart, okay, this is the forward premiums, okay, dollar INR forward premiums, and it is annualized in percentage terms. Okay, sorry, annualized in percentage terms. These are lines of the forward premiums for different days, and this, the horizontal axis is 1 month, 2 month, 3 month, all those months till 12 months. Forward premiums annualized from 1 to 12 months. If you look at these 2 days, okay, this day and this day, this is 31st and 3rd of August, the beginning of the month, the premiums were slightly higher. But if you see the remaining days, the days from 5th to 14th till yesterday, the premiums have come down. Okay, all the forward premiums have come down, and most of the forward premiums, if you see from 1 month to 12 month, it is around 2.75 to 2.85%. Okay, so forward premiums which were around 3.1, 3.15 has now come down to 2.75 to 2.85%. Okay, another big change. Now let me come to the real analysis. Okay, now we have seen the volatility has reduced, we have seen forward premiums coming down. This chart is for the option premiums. Okay, this is not forward premium, this is cost of an option. If I take a vanilla option for 1 month, 2 month, 3 month, 4 month, then what is the option premium, or what is the insurance cost for taking a vanilla option? And this is at the money, which means strike price is equal to the forward rate. So if you take options for various maturities, the blue line is 1 month, okay, this one, red is 2 months, green is 3 months, this is green, and 4 months is the yellow one. Okay. Now if you look at how the option premiums have changed, obviously beginning of the year there was very less insecurity, geopolitical risk was less, so the option premiums were more. And see how during the war time the option premiums had remained higher. Okay. But now look at how it has cooled off. The option premiums have cooled off significantly. Significantly the premiums have come down. Remember, the war is not over, crude prices are still high, but the geopolitical risk premium on the options has reduced substantially. Okay. Now what does this mean for exporters and importers? Plain and simple, if you are using options to hedge, this is one of the best time to do it. Okay. Options cost has come down, and since cost has come down, the break points will all be favorable. Okay. Remember, the risk is still there, but the cost has come down. Okay. So options as a hedging instrument, both dollar exporters and importers should do it. Okay. Now if you look at the levels, now let's come to the levels. Okay. If you see the levels are still on the lower side. Okay. Slightly on the lower side. So since the levels are lower, okay, sorry. Since the levels are lower, what you can look at doing is the importer should look to hedge. Okay. And you should look to hedge using both forwards as well as options. I showed you one of the best time to do options. So certainly do options to diversify your risk. Now for exporters, since the levels are lower, you can hold on for a while. You can look at levels back at 96, 96 plus to resume your selling. So at 96 plus levels, you should look at doing forwards more and options less. But if you are mandated to hedge in the current levels, when is it around 95, 95, 50, look to do vanilla options. That looks to be a better instruments to hedge as this point of time. Okay. So that is it from my side. Have a great